In 2025, America's car market is facing a new reality that feels less like business as usual and more like a shockwave. For decades, German automakers like Volkswagen, BMW, and Audi were household names on Main Street. They represented engineering pride, luxury, and reliability that many American families aspired to own. But this year, those same cars are suddenly thousands of dollars more expensive, and the reason sits squarely in Washington. On March 27, 2025, the White House announced a sweeping 25% tariff on imported cars from the European Union. It was framed as a move to protect American jobs and balance trade. Yet the immediate effect is simple and painful: higher sticker prices in dealerships across the country. According to estimates cited by Reuters and the Wall Street Journal, the added cost per vehicle could climb by roughly $4,000. That is not a number buried in a report. That is the difference between a family in Ohio being able to trade in their old sedan or putting it off for another year. It is the reason a retiree in Florida tells his grandchildren that the dream of a new car smell has to wait. For viewers 55 and older, this isn't just about foreign trade. It's about daily budgets, fixed incomes, and the financial stress that compounds when costs rise across the board. And it's happening at the same time as high interest rates on auto loans, climbing insurance premiums, and repair bills that never seem to stop growing. German automakers are caught between two giants: America, now closing its doors with tariffs, and China, rapidly expanding its electric vehicle footprint across Europe and Asia. The effect is a domino that doesn't stop with car companies. When sales fall, jobs disappear. When prices rise, consumer confidence drops. And when confidence drops, the entire financial system feels more fragile. This is why the German auto story matters to every American household watching tonight. Because what starts with a tariff can end with Main Street paying the price. And the question now is simple: how long can families absorb these costs before trust in the economy itself begins to crack? $4,000 more per car. Trump's tariff shock. A single number has sent shockwaves through the entire car market: 25%. That is the tariff Washington placed on imported German vehicles starting March 27, 2025. And for American buyers, that one policy means paying roughly $4,000 more for the exact same car they could have bought last year. Think about that for a moment. $4,000 is not a statistic in a trade journal. It is several months of Social Security checks. It is the copay for a surgery. It is the college savings that suddenly disappears to cover a higher monthly car payment. For families living on fixed incomes or for retirees carefully managing pensions, that extra cost can break a budget already stretched by higher food bills, rising energy prices, and healthcare that only seems to get more expensive. And it is happening at the same time interest rates for auto loans are hovering at the highest levels in decades. Banks are charging more to borrow, insurance companies are raising premiums, and now the sticker price itself is inflated by tariffs. It creates a triple squeeze on Main Street households. The Wall Street Journal reports that dealers expect slower sales across the Midwest, where German sedans and SUVs once had loyal customers. Bloomberg notes that leasing companies are revising their models, warning that monthly payments could climb by double digits. And Reuters confirms that trade groups in both Germany and the United States are lobbying furiously for relief, knowing that consumer demand may collapse. This is not just about Volkswagen, BMW, or Audi. It is about the ripple effects of one decision, one number, on communities from Detroit to Dallas. A family in Ohio that was ready to replace their aging minivan now has to postpone. A retiree couple in Arizona wonders whether their savings will stretch far enough to cover the higher cost. And a younger worker in Texas looks at the numbers and asks whether it's smarter to settle for a used car instead. So here's the blunt question: when every car on the lot suddenly costs thousands more, will Americans keep buying, or will they simply walk away? March 27, 2025, the 25% tariff hits. On March 27, 2025, the White House announced a sweeping 25% tariff on imported cars and SUVs from the European Union. The policy was presented as part of President Trump's broader trade strategy, aimed at protecting domestic automakers and restoring balance in America's trade deficit. But within hours of the announcement, headlines from Reuters and the Wall Street Journal warned that the consequences would be immediate and far-reaching. German brands, Volkswagen, BMW, Audi, and Mercedes-Benz, were singled out as the hardest hit because of their heavy reliance on U.S. buyers. The European Automobile Manufacturers Association estimated that every imported car from Germany would now cost thousands of dollars more at the point of sale. Bloomberg reported that U.S. dealerships carrying German models began receiving notices about updated price sheets as early as the following week. In Detroit, trade groups expressed concern that higher prices would drive buyers toward Asian competitors such as Toyota, Honda, and Hyundai, which were not directly affected by the new tariffs. In Germany, the Kiel Institute for the World Economy issued a statement predicting a measurable drop in exports to the United States, warning that the policy could erase years of effort to keep German vehicles competitive in global markets. Meanwhile, the European Commission confirmed it was reviewing potential retaliatory measures, including tariffs on U.S. agricultural exports. That raised alarms for American farmers, many of whom already face shrinking margins from previous trade disputes. Financial markets reacted quickly. Volkswagen and BMW shares fell in double digits during late March trading sessions as investors braced for weaker U.S. sales. American auto suppliers, particularly those linked to imported parts, also saw their stock values decline. Policy analysts interviewed by the Financial Times described the situation as a self-inflicted wound, noting that higher sticker prices in the U.S. would not guarantee more jobs at home. The facts are clear. One tariff decision on March 27 set off a chain reaction across dealerships, boardrooms, and farm towns alike, illustrating just how interconnected the U.S. economy remains in 2025. German giants bleed. American icons struggle. The March 27 tariff decision did not stop at dealership showrooms. It immediately reverberated inside the corporate offices of the world's biggest automakers. For Volkswagen, BMW, and Audi, the United States has long been one of their most profitable export markets. Now that pipeline is under strain. Volkswagen executives warned investors that shipments to American dealers would slow, citing the tariff as the main factor behind rising costs. Bloomberg noted that the company's U.S. sales targets for 2025 were quietly revised downward in April. BMW faced similar challenges. According to Reuters, its shares slid by more than 10% in the weeks following the tariff announcement, reflecting investor fears that higher sticker prices would crush demand. Audi, though smaller in volume, also faces margin pressure as luxury buyers weigh whether a German SUV is worth several $1,000s more than a Japanese or Korean rival. The squeeze is not limited to Europe. American automakers are also caught in the crossfire. General Motors and Ford rely on global supply chains that include parts manufactured in Germany. The Wall Street Journal reported that component costs for U.S. assembly plants are rising, forcing managers to recalculate production schedules. Even Tesla, often portrayed as insulated by its domestic electric vehicle production, is watching cautiously. Analysts warn that if German brands retreat from the American market, Chinese EV makers may fill the gap, and that means tougher competition for Tesla in its own backyard. Beyond autos, other industries know this story too well. Boeing, once the pride of U.S. aerospace, has already seen contracts evaporate after previous tariff disputes. The parallel is clear. When tariffs are imposed, corporate earnings erode, investor confidence falls, and global competitors move in. For the automakers, the stakes are massive. The German auto industry contributes roughly 5% to Germany's GDP, according to the Kiel Institute. Losing traction in the U.S. is not just a quarterly problem. It is a structural threat to long-term survival. For American companies tied to the same supply chain, the message is equally stark. Tariffs may be framed as a shield, but in practice they are cutting deeply into corporate balance sheets on both sides of the Atlantic. Main Street feels the sting. For most viewers, the impact of Trump's 25% tariff isn't measured in corporate earnings reports. It is measured at the dealership, in the monthly budget, and in the daily trade-offs families now face. According to Reuters, the average German sedan or SUV sold in the U.S. will cost roughly $4,000 more under the new tariff. For retirees on fixed incomes, that price jump is a deal breaker. One Ohio couple told Bloomberg they had planned to trade in their 10-year-old Volkswagen, But after running the numbers, they decided to postpone the purchase indefinitely. And that decision ripples outward. Fewer car sales mean fewer loans issued, fewer insurance policies written, and fewer repair contracts for local garages. Auto financing costs are also climbing. The Federal Reserve reports that average interest rates on car loans in 2025 remain near multi-decade highs. That means even if a buyer is willing to pay the higher sticker price, the financing costs can push the total out of reach. Insurance premiums are adding to the squeeze. The Wall Street Journal notes that U.S. auto insurance rates have jumped nearly 20% over the past year, partly due to higher repair costs and parts shortages. For a retiree in Florida or a young family in Michigan, that means every angle of car ownership is more expensive. Repair bills are rising too. Imported components now carry tariff surcharges, forcing mechanics to pass along the costs. What was once a $500 brake job can easily top $700. The consumer impact is not limited to luxury buyers. Middle-class families who once stretched their budgets for a reliable German car are now looking at used models or shifting to Asian brands unaffected by the tariff. In short, the policy that was supposed to protect American wallets is leaving Main Street households squeezed from every direction: purchase, financing, insurance, and repair. And the question is no longer whether people will buy, it is whether they can afford to buy at all. What happens next? The question now is simple. What happens next? In the best-case scenario, Washington and Brussels return to the negotiating table. Trade groups in both countries are already lobbying for exemptions, and a deal that trims the tariff rate could stabilize prices at U.S. dealerships. That would not erase the damage, but it might slow the exodus of German automakers from the American market. In a mid-case outcome, the tariffs stay in place and consumers gradually shift their purchases. Japanese and Korean brands, Toyota, Honda, Hyundai, and Kia, stand to gain market share as buyers look for more affordable alternatives. U.S. companies like General Motors could see short-term bumps, but rising parts costs could still undercut their advantage. The worst-case scenario is more disruptive. German automakers reduce exports, pull investment from U.S. plants, and shift more production toward China, where EV demand is booming. At the same time, retaliatory tariffs from Europe on U.S. farm exports hit American heartland communities already struggling with tight margins. That is the point where a policy aimed at protecting American jobs becomes a drag on both continents. And then there is the wild card: Canada and Mexico. Analysts warn that if Canada strikes a deal to supply German automakers with steel and critical parts, the U.S. could be left watching its neighbor profit from a redirected supply chain. Mexico, under pressure to block Chinese EVs from sneaking into North America through back doors, may also reshape the trade map. For Main Street, these scenarios are not abstract. They determine whether cars remain affordable, whether pensions hold value, and whether the trust in economic stability survives another shock. From sticker shock to trust shock, when the headlines fade and the policy debates drag on, what remains is the lived reality for American families. The German auto crisis under Trump's 25% tariff is not just about cars. It is about how one decision can ripple through balance sheets, supply chains, and kitchen tables across the country. From sticker shock at the dealership to shrinking retirement budgets, the impact is clear. This is not a story of foreign corporations alone. It is a story of Main Street households forced to pay more, wait longer, and trust less. Investors call it earnings erosion. Consumers call it unaffordable. For retirees in Florida, factory workers in Michigan, and young parents in Ohio, the labels do not matter. What matters is that life just got harder. And when trust in affordability breaks, confidence in the broader economy begins to crumble. From sticker shock to trust shock, this moment reveals how fragile the system can be when global industries collide with domestic politics. The verdict is simple. A tariff designed as protection has turned into a burden, leaving Main Street to shoulder the weight of a global economic fight it never asked for. Would you pay more or walk away? So now the question comes back to you. Would you pay thousands more for the same car, or would you simply walk away? Across America, families are already making those choices every day. Some are holding on to older vehicles longer than ever. Others are turning to used cars, carpools, or cheaper imports from Asia. And retirees on fixed incomes are rethinking whether a new car is even possible. This is not just about the auto market. It is about trust, affordability, and the future of Main Street. What do you see in your own community? Are local dealerships emptier, or are neighbors struggling with higher payments? Share your story in the comments below, because these lived experiences matter more than any statistic. If you want to keep following how global trade decisions hit home for ordinary families, consider subscribing and turning on notifications. And above all, remember, the data we share is for information only. Your choices depend on your own needs and circumstances.